Um, right, guys, let's see what we want to cover today. As per usual, it's the monthly update, so we will cover whatever is new in tax law from late October to last week Friday, to be exact. um, there's, as I said, it's the last one for the year. If there is anything that we are covering in this session and you would like to find or read a hard copy of this judgment or the ruling or whatever it is we're covering, you can access those on my website. The link is in the slides, or you can access them on SARS's website or Treasury website, or there's many places you can access it. All right, as I always say, we can't cover everything in detail. We try and extract as much value as we can in relation to a particular amendment, while at the same time trying to keep it as relevant as possible. And I understand that not everything that we're covering is necessarily relevant to everybody. For example, you might not have a VCC as a client, and so if there's a ruling, for example, the one we're covering on VCCs, it might not be immediately relevant to you. But you never know when something is going to come across your desk. If there's anything that we've missed in this update, please let us know and we'll consider it for inclusion in next year's update, assuming you guys still want us to present this next year. As far as I know, we are going ahead with this next year. So if there's anything we've missed, please let us know. All right. All right, in specific, we're going to briefly look at tax in the news, just out of interest's sake. A couple of general developments I'll mention. Those are typically changes or developments in the tax law space that's not worth really covering, but at least worth taking note of. Practical issues, guys, you can remember to email me your practical issues if you're experiencing issues with e-filing or SARS or a branch. You're more than welcome to email those through. To the extent that we find an answer, we will give the answer. And to the extent we don't have the answer, I'm sure somebody who's listening might have an answer. And if anything, it gives you at least the reassurance that not everybody is struggling with this. Right. Then, in particular, we're going to look at Binding Private Ruling 333, which deals with a venture capital company, in particular, whether or not an investment in essentially farming operations would qualify, because we know that there's that exclusion to say if you invest in a company that carries on a trade in respect of immovable property, that investment doesn't qualify. The target company wouldn't qualify. And so obviously where there is investment in farming operations, that would necessarily involve farming operations and would necessarily involve fixed property. And the question then is, well, is farming operations considered a trade in respect of immovable property? And as I always say, I have one client who's a VCC. And the problem with VCCs, or one of the challenges facing a VCC, is that it is necessarily driven by tax law. That's kind of the nature of the vehicle. And if you're making an investment into a company that doesn't qualify, in terms of the VCC rules, you could be jeopardizing the entire VCC and everybody who's invested into that VCC. And so that's why we see so many rulings in the VCC space. If you're unsure, get a ruling, because the risk is just not worth the gamble. And so that's why we get many rulings, and Vickers will take you through that ruling. Then there were at least 4 interesting judgments that came out, 3 or 4 roughly. Interesting judgments, 5, is it? Well, quite a lot of judgments that came out in the last week or so, and all of them, in my mind, extremely important. So the first one is ITC, or Income Tax Case 14434, judgment handed down on the 28th of June 2019. We're only covering it now because it was only published now. Often you see judgments that were handed down last year and it's only published now. Oftentimes the reason for that is because the typesetter or whatever, the person who types up the judgment, they have to go and sanitize the thing and they have to go type it up, and sometimes it just takes a while before it can go out and become public knowledge. So this is actually quite recent, the 28th of June. Then Income Tax Case 13862 and VAT 1374 is a very interesting judgment dealing with whether or not SARS was allowed to amend its Rule 31 statement. So Again, just to put it into context, if you're going to go on dispute and you get to litigation, then SARS has to file its statement of grounds of assessment and opposing appeal. That's called the Rule 31 statement. And what happened here is SARS they issued one, or filed or served or delivered, I guess is the word used in the tax court rules. They delivered their Rule 31 statement and then wanted to change it. And the taxpayer challenged that. Interestingly, it seems as if the court's not oblivious to it. The court does mention that the wrong procedure was followed, but it seems nobody raised it, and so the court had to deal with what's in front of it. But I think they followed the wrong procedures. They would, be that as it may, Liesel will tell you a little bit more about that. Then a application for default judgment was application 35 of 2019, judgment handed down on the 11th of September 2019. And this case has got some similarities to something that was in the news fairly recently regarding a certain person who received a tremendously large donation from some foreigner, and they declared it as a donation. Turns out it's taxable. All right, but what happened here was a default judgment application, but it's almost a comedy of errors that were made by both SARS and the taxpayer, and ultimately resulted in the taxpayer not getting default judgment. But I thought it was quite opportunistic of the taxpayer to try that route, but nevertheless they failed. Very interesting judgment. I'll take you through that. Then taxpayer versus SARS is another case on capital or revenue, whether or not a certain amount written off, if you will, whether or not that loss that the taxpayer suffered on write-off, whether that loss was of a capital or revenue nature. And Vickers will take you through that judgment. What I find very interesting about that judgment is it seems to go against the principle in the solid glass finance case. It says if you write off a loan, then it's capital unless you are a money lender and you satisfy those characteristics set down in the solid glass case. But then the taxpayer argued it's not a loan to start off with. And I think that's where things went a little bit astray. I know myself and Vickers has got a little bit of a debate going about whether the judgment is right or not, but a very interesting judgment nevertheless. Vickers will take you through it. Taxpayer versus SARS. It deals with the refusal by SARS to grant the transaction count-based apportionment method for input tax. So SARS gave a ruling and the taxpayer wasn't happy with certain aspects of the ruling and eventually followed the objection process. And very, very interesting is this issue of whether you can in fact object to it, and second of all, whether or not SARS can backdate or must backdate a VAT apportionment ruling. So if you go for your input tax apportionment ruling, how far can SARS backdate it? Because this taxpayer wanted it to be backdated to a certain point, and SARS refused to backdate, and the dispute eventually ended up in court. Right, and then as per usual, we'll briefly touch base on the SARS dispute resolution judgments, just give you an overview of the win-lose ratios, and then as per usual, the not covered list and the rollovers. Are there any? No. Right, so there's nothing that we saw happen that we're not covering in this month, and also there's nothing that rolls over. Or there is something. There's a not covered. Oh, of course. All right, so there is one or two things. Sorry, guys, I am in the middle of presenting the year-end update as well, and so my office had to prepare this very quickly. But nevertheless, you'll get full value out of it. I'm very confident that you'll get full value. All right, tax in the news. Court holds off issuing public protector subpoena forcing SARS to release Zuma's tax information. All right, so there's this whole issue out of interest sake about the public protector wanting tax information relating to Jacob Zuma. And SARS's issue with releasing this information stems from this confidentiality, or the confidentiality provisions in the Tax Administration Act. So SARS is sitting between a rock and a hard place, because the TAA says you must treat the information as confidential, and there's another act that says if the public protector asks for it, you must give it. So if you give it, you're committing a crime. If you don't give it, you're committing a crime. And so as far as we can tell, it seems from what we read in the news that SARS is approaching the court for some form of relief as to whether or not it's allowed to give this information or not. I would imagine it takes the form of a declaratory relief or something to that effect, and that's why they're not giving the information. We'll have to wait and see what happens there. Then also, the commissioner has said that they're going after scrap metal industry, taxpayers in the scrap metal industry, fuel and cigarette fraudsters who costed billions. Apparently, the non-compliance and the fraud by taxpayers in this industry has cost the country tens of billions of rands. What I found interesting about this is the commissioner said, was quoted as having said in this article, that they are also going to go after companies that sell shelf companies, right? Taxpayers that sell shelf companies, because as far as I can tell, the logic seems to be that people commit VAT fraud using shelf companies. So they'll buy a shelf company, claim a bunch of refunds, get it paid out and kill it, and then buy another one. And repeat the process. And so, as far as I can tell, the commissioner seems to suggest that people who sell shelf companies are just as much part of the crime as the people who commit the crime, which I thought was rather aggressive. But nevertheless, they are saying that they're going after taxpayers who sell shelf companies. Right. Then also, apparently, Ms. Mokuna, who was the SARS head of legal at one point in time, apparently, she's been fired. All right. And the reason for that, as far as we can tell from the article, is that she was involved in issuing an opinion to the then Commissioner Tom Moyane to say that you can release the VAT refund and the income tax refunds into third-party bank accounts. And apparently that led to her being fired eventually. Right. So there seems to be some movement in SARS. I understand there's a bunch of other people who've just resigned, even though the disciplinary hearings are still pending, or was pending at the time. But there seems to be some shake-up in SARS this time, it seems, at least for the better. Right. Then general developments. Right. So there is the Marshall and others versus SARS, which was effectively leave to appeal to the Constitutional Court following an adverse judgment from the SCA. And this is what I generally refer to as the Red Cross case, the Red Cross Air Mercy Service Trust, I think is the right trust. It's actually Marshall nomino officio in his capacity as trustee of the trust. But you'll recall, some of you might recall, that this thing has got a whole history to it. The taxpayer applied to SARS for a ruling to allow it to zero rate certain services it rendered to the KZN Health Department on the basis of Section 8.5, which deems certain supplies to take place and consequently triggers the zero rate. And SARS refused to give the ruling. Then they went on appeal, or took it on review in, I think it was the High Court, and then where they lost, and then the SCA where they lost, and then tried or applied for leave to appeal to the Constitutional Court. And all this judgment says is that leave to appeal is not granted. It's not a constitutional matter. And so the Constitutional Court can't hear it at all. Out of interest sake, that is a very, very interesting judgment. If you have clients in the public benefit organization space, welfare organization space, the VAT treatment, especially if they do work for government entities, the VAT treatment of the amounts they receive can become tremendously complex. It's such a thin line as to when you are rendering a service and when you are getting a gratuitous amount as a grant. Because grants are subject to 8.5 and zero rated, but if it's for a service, it's not. And it can become a very thin line, and it can be detrimental to a PBO if it turns out that it's actually not a grant, it's actually for services rendered. Right, then also, this is a judgment I believe I've covered somewhere earlier in this year, but it was only published recently, I think on SARS's website. Doesn't matter, it's a fairly old judgment, SARS versus Danwood. And it deals with this issue of appeals and whether the tax court had jurisdiction to do certain things, and it gets very technical. But something that I can tell you that you can take from the judgment is just a reminder that if you lodge an appeal, you have a maximum of 75 days to lodge the appeal. After that, you are pretty much dead in the water unless you approach the court for an extension of the period to lodge an appeal. Right, then also the bills were published. So this year's round of amendment bills were published. Taxation Laws Amendment Bill, Tax Administration Laws Amendment Bills. Those are the things that we have to work through, unfortunately, if we operate in the tax space. I am currently doing the year-end update where we are covering some of the amendments in the bills, and there's been one or two changes from the draft bills to the final bills. I am in the middle of the year-end update. I think tomorrow is Joburg, and on Thursday is Pretoria, the session, and then next week sometime is a webinar. So for those of you interested in the year-end update, we will be discussing some of the bills, some of the changes, at least in the bills. Right. Also, very important, they issued their revised draft response document, and those things, all of these documents are extremely important if you operate in the tax space. Sometimes when you read the legislation, it isn't entirely clear what they wanted to do, and the easiest way to figure out what it is they intended to do is to go and read through the explanatory memoranda and the response documents and the bills on the draft to the final bill and see what they changed, because it gives you an idea as to how to interpret the relevant provision. Right, practical issues, as I said, you can email those to me and we'll consider them for next year's discussion. That then brings us to binding private ruling 333 or 333, dealing with VCCs and the investment in farming operations. And at this point, I'm going to hand you over to Vikas to take you through this ruling. Thanks, Vikas.
Okay, the parties to the BPR is quite simple. So the applicant is a resident company and an approved venture capital company, and the operating company is a resident company. So the proposed transaction, the applicant will subscribe for shares in the operating company. The operating company will undertake farming operations, and the operating company will either purchase, sorry, that's a typo, or lease land required to undertake the farming operations. And when they did secure the land, they will establish it, and the establishment will include fences, drip irrigation, cold rooms, etc. Okay, and then the ruling was the farming of blueberries by the operating company will not constitute a trade in respect of immovable property for purposes of paragraph A of the definition of impermissible trade. So what does paragraph A state? Definition of impermissible trade, it's any trade carried on in respect of immovable property. So the farming operations is not a trade in respect of immovable property.
Right, thanks. Because I think it always sounds simple when you read the ruling, but it's such a major risk. And indeed, I would agree that if you're going to do farming operations, you're not actually buying and selling. You're not buying and selling farm. You're just you're carrying on farming operations, which indeed would include immovable property. But nevertheless, now we know that you can invest in farming operations in a VCC, and that is not impermissible. Interestingly, I mean, there's probably when it comes to rulings, there's always that risk, especially on VCCs. If you've got a VCC who gets a ruling on something, then it benefits all the other VCCs, and I understand it's quite a competitive space to operate in, and so therefore the guys are sometimes quite reluctant to apply for a ruling. And would rather take alternative measures to try and mitigate the risks of getting SC opinion or something to the effect. But be that as it may, now all VCCs know you can invest in a farm. Right? It should be okay. All right, guys, I just want to quickly pause and interrupt myself for a second just to check the sound. Can everybody hear fine? Is the sound good? Because I'm seeing one or two concerns with the sound. Sound seems to be perfect. All right, great. So that's the exception. All right. That brings us to income tax case 14434, and it deals in particular with section 13 Quin. Now, just to remind you again, section 13 Quin is the commercial building allowance. That if you have a commercial building, then section 13 Quin gives you a wear and tear allowance or a depreciation allowance in respect of the cost of the building. And this judgment really dealt with a case where, and Vikas will take you through it, but dealt with the case where a taxpayer didn't claim the 13 Quin allowance in respect of a particular year or years of assessment, and then sought to catch up, right? So it said, okay, I didn't claim in the last 3 years, so we'll just claim the last 3 years worth of allowances in the next year, right? That's what they effectively wanted to do. And they found, or tried to find support for that argument in this particular section, Vikas will explain. But this is something we come across often. Where guys say, well, it's just especially, well, let me not say that, but you often find cases where the guys would say to you, but it's only a timing thing, man. What's the big deal? I claim it this year, claim it next year. Who cares? I'm claiming it, right? That's the same thing. It's not that simple. There are specific time periods within which you have to claim it. And if you claim it in the wrong year, your claim would be overstated. And that would mean you are illegally claiming something which will expose you to, obviously, the underlying tax as well as understatement penalties. But be that as it may, this taxpayer tried to find support in the legislation itself for arguing why it can claim effectively a lump sum those claims that it didn't make in previous years. And if you, as Vickers explains to you their position, and you don't understand, don't worry. I think nobody here understood what that section was supposed to do. That's why it went all this way to tax court. But anyways, over to Vickers.
Okay, so the issue for the court was whether subsection 3 of section 13 Quin allows for deduction which a taxpayer was entitled to in a previous year of assessment in a subsequent or in the current year of assessment. So section 13 Quin, subsection 3 states, or basically says, if a building improvement, you could have claimed a deduction in a previous year of assessment, the first time you brought that building or improvement into use by the taxpayer for use in his trade, and the receipts and accruals were not included in income of such taxpayer, and therefore you couldn't get the deduction, then those previous deductions that you could have gotten is deemed to have been allowed.
Right, so effectively what the thing says is it says that if in previous years you traded but you generated income that's not subject to tax, so effectively what that means is you were exempt, then if you didn't claim it because you were exempt, then you are deemed to have claimed it. You can't now start, because the argument, if it wasn't for that section, and I'm probably jumping the gun here, but you can go through the judgment anyway. If it wasn't for that section, then one could very well argue that if I have only exempt income in, let's say, years 1 to 5, and I start making taxable income in year 6, then I'm going to start claiming my building allowance in year 6 as the first 5% or whatever the ratio is given for certain Quin. So that section specifically says, no, if you only earned exempt income or you weren't subject to tax previously and you had the building, then you are deemed to have claimed it. So if you lost 5 years, you lost 5 years. That's effectively what the section says. But the taxpayer, for some reason, thought that he could use this section to essentially catch up the 13 Quin claim. That's what they tried to argue, which makes zero sense, but that's what they did. Right, we just carry on.
Okay, so the text, a little bit background. So the respondent or SARS allowed a deduction or section 13 Quin deduction in a 2014 year of assessment for about 1 million, but the taxpayer claimed 6.6 million. And that claim related also to the 2007 to 2013 year of assessment. And that was disallowed by SARS. So the taxpayer stated that the respondent will not be prejudiced if the allowance is allowed, because if it sells a property, it will be recouped in the future. And also the subsection 3 of section 13 Quin is ambiguous and therefore needs to be interpreted in favor of the appellant.
Right, sorry, because this is just, the more I see this, the more it boggles my mind. So this is an argument we see often, especially from taxpayers, to say, but what's the first of all, it's just a timing thing. Then second of all, what's the problem? If I sell the thing, I'm going to recoup it anyway. So really, what's the big deal? Let's just lump it together, right? So I understand the logic, but that's unfortunately not what the section says. So you can try and argue that, as this taxpayer did and lost, and that's what we always say. You can try it, but you're going to lose. Also, this other argument they're using about subsection 3 being ambiguous, they're almost trying to argue the contra fiscum rule, which is that doctrine or rule or whatever, or what is the right word, Liesel? Anyway, there's that thing in law that says if fiscal legislation is not clear or ambiguous, then you must interpret it in favor of the taxpayer, which I think is just not clear if you don't understand what it plainly says. But it is actually very clear, if you ask me. But that was the arguments, which makes, anyway, here we go.
Okay, and the arguments for SARS was the appellant has failed to tender evidence to establish that subsection 3 is ambiguous and therefore cannot invoke the contra fiscum rule. And tax is an annual event and is for that particular year, and therefore the deeming provisions in subsection 3 of section 13 Quin should apply in the case of the appellant. Just more background, the taxpayer said they didn't claim the 13 Quin allowance because the accountant forgot.
So in other words, it wasn't an issue that they were exempt previously. It was just neglect of the accountant. Yeah. That's what it comes down to, right?
Okay, and what the court basically said is also said, as they understand, tax is an annual event, and respect to which that annual event the tax is chargeable, and the appellant's failure to claim those allowances in the deemed the allowance to have been claimed as allowed deduction for past years. So that's subsection 3. So the courts basically said those allowances were deemed to have been claimed in those previous years, and then just goes on to say you can't lump it together and claim it in that year.
Interestingly, what the court says is the court expresses a view as to the purpose of the subsection, to say the deeming provisions, in my view, were inserted in section 13 Quin to prevent taxpayers from delaying in applying for these deductions and to avoid unnecessary cash flow problems. With respect, that is not the intention of subsection 3. It was simply there to say if you were exempt previously, now become taxable, then you would be deemed to have claimed it in previous years. That's the purpose of the section. In fact, when you go and read the EM that introduced subsection 3, that's exactly what they say the purpose is. So I don't understand why we've got this purpose, but be that as it may, it could be because that was what was in front of the court. And yeah, all righty. Right, and ultimately the taxpayer lost. The appeal was dismissed. Right, rightly so. Good. Taxpayer versus Commissioner for SARS. And this is a question, as I've said earlier, it's a case of whether or not an amount written off by a taxpayer is capital or not. So the capital or not. So the taxpayer had about 18 million rand due to it, which apparently you don't call it a loan if it's due to, but let's not go there. I've got a couple of reservations about this judgment and the correctness with respect to this judgment, but I haven't yet had the opportunity to properly apply myself to it, and so therefore I'll just for now not comment too much. But the point is there was 18 million rand receivable or due to the taxpayer, which is apparently not a loan, and that had to be written off. And SARS said it's capital, taxpayer said the loss is revenue, and that's the dispute. Right, and that's what's in front of the court. But over to Vikas.
Yes, okay, so the issue in dispute is the 18 million expenditure loss, or whether it has revenue capital nature. Background to the case, so the appellant or the taxpayer and K are both subsidiaries of B. And also, okay, not in the slides, just a little bit more background is the taxpayer and K conducted a business of purchasing fruit locally and exporting it to the export market. K was used occasionally to avoid conflict between some of its customers. So the taxpayer is actually the trading entity. The taxpayer's major supplier had financial difficulty, and the taxpayer acquired the business or tried to acquire the business of its major supplier. Its normal financing institution couldn't provide finance to it, so there was another party that said they will provide finance for the purchasing of its supplier, but they need pro forma invoices for the sale of the fruit before they can provide the finance. The taxpayer couldn't use the finance because of the agreement they had with the current financial institution. So K purchased the business by using the financer. Then the taxpayer said they would sell the fruit to K on consignment, and K would sell it in the export market. And K issued pro forma invoices. Pro forma invoice were issued to the taxpayer. The sale price to K was not fixed, and it was based on whatever price K could obtain in the export market for the fruit. And any money received by K would first be paid to the financier, and then any residue would be paid to the taxpayer. And then also the taxpayer included the sales in its revenue line item, and then also the cost of sales for the purchase of the fruit. And the taxpayer would provide necessary resources and incur expenditure and that will be charged to K, because K didn't have the resource to do it themselves. And that's basically other facts.
Right, so effectively what happened here is we had a business here that had two subsidiaries, and it had a major supplier from where it bought fruit, and that supplier was running into difficulty. And they knew that if they didn't have that, I would imagine, I'm just thinking generally business-like manner. So they knew if that guy runs into difficulty, I'm not going to be able to buy the fruit to sell it, so my business is going to suffer. So what I'll do is I'll just go and buy them. I'll go buy that business. But I need finance to do that. And because of a bunch of red tape, it seems they couldn't actually generate the finance. So they said, okay, fine. If I can't generate the finance as the taxpayer, I've got this subsidiary buddy of mine, K. So we'll use him or it. We'll use subsidiary K because we can arrange finance through that. And so what we'll do is we'll do this change transaction whereby I will get, or K will get the finance, and it will then acquire the fruit from the taxpayer, and the taxpayer will pay F for the fruit that it bought. So that's fine. And then the taxpayer will also get money for the sale of the fruit as and when K sells it. Right? It was really just a mechanism to get around red tape so that they ensure their business keeps going. Right. And so the issue was that this taxpayer had all the resources to buy and sell the fruit because that's the one who actually did it. K was, as far as we can tell, was pretty much a dormant company. So it had no resources. So what they said is, fine, K, I will help you sell the fruit and then I'll just recover the cost for that service that I'm rendering from you. That's effectively what it comes down to. And then at some point in time, K was unable to pay for all of this, right? Because the plan didn't work out as they wanted to, and they suffered a loss ultimately, with the ultimate result being that K owed the appellant 18 million rand, and that was written off, right? And so SARS said, but that's a capital loss, and the taxpayer said it's a revenue loss, and that's where we're at.
Yes. And then also K accounted for the amount written off as additional income and declared part of its taxable income. The taxpayer stated that it was no advance of money to K by it. The account recorded ongoing transactions between the parties for the year, and also the expenditure was incurred by the taxpayer for purpose of providing logistical supports to K to ensure the success of the taxpayer's own business, involving the sale of fruit to K on consignment.
Right, so effectively saying that it's not a loan, because we know if it's a loan, right, and you're not a money lender and you write the thing off, Solid Glass will tell you it's a capital loss, right? That's what it is. So I have to say it's not a loan, but I'm still struggling to understand on what possible basis is it not a loan. If I say you owe me 18 million, what is that then if it's not a loan? But anyways, that was the argument. A taxpayer actually won the case. Sorry for the spoiler, but I'm still trying to figure out why it's not a loan. But anyways, that was the gist. The gist of the argument was it's not a loan. This is actually just a business relationship, in terms of which I would do certain things for my own account, actually, because it was all oral agreements as you read the judgment. I will do certain things and then you must just pay me back. It's actually just in the production of my own income. I'm just using you effectively as a tool to get around red tape. That's kind of, if you could summarize it, the gist of the argument.
Yes. And also, SARS accepted that the amount owing by K to the taxpayer was deductible, trading expenditure, and then they said the loan was capital.
Okay. So hang on. So SARS said that, because remember what would happen is I would incur, the taxpayer would incur the expense, right? Actually incur the expense, but it would reflect it as a receivable. The expense would be deducted for income tax purposes in K. Okay. Right, and so when they wrote off the loan, apparently it's not a loan, when they wrote off this thing, whatever it is, no, it's not even a debt, but if they wrote off this thing, what happened is in K's books, they reversed it as a recoupment of the expenditure, right? So the SARS did that, but they said that on our side, the taxpayer side, it's capital.
Yeah. Okay, and then the judgment, the nature of the expenditure relates to the taxpayer's taxable business and was concerned with its revenue stream. It could have made a profit on this. This was not investment with supporting the extraordinary business of K. The expenditure loss didn't amount to deployment of fixed capital to equip the income earning machine. It is indebtedness that arose from trading activities, therefore deployment of floating capital. The loss expenditure was of revenue nature, and then the additional assessment should be set aside.
I'm still baffled by this judgment, I must be honest. Something seems to be amiss here, and I think where it might have gone a little bit off course is by going directly and looking at the substance rather than the form. And my understanding is you look at the form unless it's a simulated transaction, and then you go after the substance of the transaction. So here in form, we clearly had two legal entities. We had entity taxpayer and entity K. And it's almost as if the court ignores the existence of the two entities and says, well, I understand you had this strange relationship in terms of which K will sell the fruit and you will then benefit as part of the profit, almost seeming to say that it's almost a joint venture. Because in that basis, yeah, I get it. It's my cost as well, and so it's my portion of the profit, and so this is just a revenue. It's normal floating capital. That makes sense. But we'll see. I truly hope that SARS takes the case on appeal, not because I have anything against the taxpayer, but I want legal certainty. Because what then is a loan and what's not a loan? And on what circumstance do you write it off? Maybe it wasn't defended properly. I don't know. But be that as it may, that's the judgment we have. Right. Sure, one could say it's an advance, but how is an advance different? If it's an advance, you still need to be repaid. So I don't know. Willem, thanks for your, I think it's Willem, thanks for your comment. All right. Then it brings me to, is this still part of the judgment? Okay, let's carry on. I think the judgment is wrong, with respect. We'll see how it goes. Vickers disagrees with me, but that's good. We need to have debates about these things. Let's carry on. Oh, I can do that. Right. Right. This is where the court goes into all the capital and revenue tests that it used, because we all know there's no set test for capital versus revenue. There are several tests: fixed and floating capital, enduring benefit, all those sorts of interesting things. The court does find support for its view. It's not as if the court just goes against authority completely. It does find support in its view, but what I found striking as I was reading through this judgment briefly, in all honesty, yesterday, is that they're all tax court judgments. What about the solid glass finance case, which is an SCA judgment? Okay, let's move along. This brings us to Mr. X versus SARS, and as I said, it deals with this question of whether or not SARS could amend its Rule 31 statement. Right, so as I've said, just again to give you some context, if you go to litigation, you file your notice of appeal, your Rule 10 notice on e-filing the NOA. SARS has got 45 days to respond to give its Rule 31 statement, right? Which they did, but they later wanted to change it, and the taxpayer took issue with that, and that's why we have the judgment in this tax court. And Liesel will take you through this case. Thanks, Liesel.
Right. So yes, as Nico says, in this matter, the issue, or at least the salient issue, is whether SARS would be allowed to amend its statements of ground of assessment, even if it was way outside of the prescribed time periods. Right, so just to quickly go over the facts of this matter. Oh dear, did I click too many times? Sorry. Yes, so during 2011 to 2013, SARS conducted this audit into the taxpayers' income tax and VAT affairs, and an additional assessment was raised for certain tax periods. And obviously the taxpayer then went ahead and objected. The objection was obviously disallowed by SARS, and in respect of this disallowance, SARS gave certain reasons. A taxpayer then appealed against the disallowance and first elected to refer this whole dispute rather to ADR than to litigation. That whole process was not successful, and to make a long story short, eventually the matter was referred to the tax court during on or about July 2015. So in terms of Rule 31 of the tax court rules, then SARS was to file, as Nico said earlier, its statement of grounds of assessment within 45 days. So that would have been by the 5th of October 2015. But still by 5th of December 2016, which is more than a year later, SARS was placed in default. So I'm assuming that just means the taxpayer or the taxpayer's attorneys informed SARS, look, you're in default, it's been more than a year, you're really late in issuing or filing these statements in terms of Rule 31. And SARS then eventually did file its statements in terms of Rule 31 during January 2017.
So interesting to note here, these will just go back one slide. No, that's fine. Is that the taxpayer put SARS in default? So SARS was placed in default. This is more. What did you say, Liesel? About a year later. Why not? Just out of interest, like why not apply or file notice of intention to apply for default judgment? And already there, you get the idea that these guys seem not to be familiar with the rules of the tax court. Because why do you place them in default? You serve notice of intention to apply, and then you can extend, etc., etc. But this is something, Liesel, if I stand to be corrected, but to place someone in default is something you would do under the uniform rules of court, right? Which is not the tax court rules. It is perhaps similar in places, but it is most certainly not the same. It is very, very unique. But anyways, that's what they did, and then SARS filed it. SARS eventually filed their Rule 31 statement. Fine, let's move on.
Yes, during the next year. Let's not take another year. Right, so SARS's statements of ground of assessments that it filed now in January 2017 were slightly different from the grounds that SARS initially used or advanced for the disallowance of the taxpayer's objection. But yes, there's a lot of detail that I've left out of the slides here. There were meetings, there was correspondence, there were further ADR procedures going on that were not successful. But and partly why SARS, I might mention now, wanted to change or why the grounds differed is because the taxpayer said for the income tax, if memory serves, for example, that the amount was not set out properly by SARS.
And it's Rule 31.
Yes, in its Rule 31. So the taxpayer complained about that. SARS wanted to amend it, and then the taxpayer now was not satisfied with this. It said that SARS was introducing some new grounds.
Right, as far as we can tell from the judgment, it seems to what have happened here is that SARS filed their Rule 31, obviously in haste, in some haste, because they were placed in default, right, some haste. What then eventually transpired is because there was a difference between what they initially said their grounds for, it seemed that there was a difference between what they said initially their grounds for assessment is and what they're now saying in their Rule 31, the taxpayer asked SARS and said, listen, guys, because it's not exactly the same. It seems to me that there are certain things that you are simply conceding to because it's not in your Rule 31 statement. And remember, the issues in front of the court are only those contained in the pleadings, which would include the 31. So if you've omitted something from your grounds of assessment initially, and you then, if you omitted something from your grounds of assessment in the Rule 31 statement, arguably it seems you've conceded. And it seems as if SARS then responded by saying, okay, this guy is already going on about us conceding to things. Whether or not that's right is irrelevant, but let's rather just amend our Rule 31 to make it more clear. At least that's what it seems like from the judgment, right? So SARS then eventually told the taxpayer on the 15th of May that it has the intention to amend its grounds for assessment and opposing appeal.
Yes. Here's the next slide. Yes, SARS then subsequently formally sent the taxpayer a notice of intention to amend, also during May 2019, and in accordance with Rule 351 of the Tax Court Rules. Now, the taxpayer, it seems, filed an objection to this notice of intention to amend, rather as if it was busy litigating in terms of the uniform rules of court, so the High Court rules instead of the Tax Court rules.
Right, so the correct procedure, actually, if a party wants to amend its grounds or its pleadings, then the tax court rules will tell you that you can either do it by agreement, and if you don't get agreement, you can apply with an interlocutory application to the tax court to ask for the amendment to be allowed. And then, of course, the taxpayer can oppose it in this case. But for some reason, SARS correctly filed its notice of intention to amend, and then the taxpayer objected to it, which the tax court rules simply don't make provision for that, right, which seems rather strange. But nevertheless, that's what happened, right? So I just thought I'd point the correct procedure out. I think the reason why the court didn't point it out is because nobody raised the fact that it doesn't actually have jurisdiction to hear this objection thing that you're bringing. Right, taxpayer, because that's the taxpayer's application. It's objecting to the amendment, which doesn't make any sense. It would have been a notice of intention to oppose an application for amendment. But anyways, that's what happened.
Yes, it's very strange indeed, because as Nico points out, in terms of Rule 351 of the Tax Court Rules, if SARS lodges or files or delivers rather a notice of intention to amend, then either the taxpayer can say yes, it's fine, or if they say no, then SARS would have to go to court to try and get permission. But now this taxpayer goes to court to object to the notice. Very strange. Nevertheless, the court entertained this matter. The taxpayer argued that SARS was now trying to introduce new grounds in the proposed amendment. In its proposed amended statements of grounds of assessment, SARS had failed for over 2 years to actually effect or try to effect or introduce this amendment, so that amounted to a concession or abandonment by SARS, and that the taxpayer would be prejudiced if the amendment was to be allowed. Now, the court goes into a lot of detail about High Court judgments, SCA judgments, and so forth, of up to 100 years plus back, which is trite law, that when the court may grant an amendment and when it may not. SARS, but yes, I digress. SARS, on the other hand, then argued that the proposed amendments did not introduce any new grounds. It rather just served to elucidate or clarify the exact amounts for income tax in that specific instance that were allegedly underdeclared. The VAT matter, they just dropped some of their grounds, but yes, then they also said in terms of, or with regard to this concession, no concession was made and the taxpayer would suffer no prejudice, at least no prejudice that couldn't be remedied by a cost order, which I'll get to in a moment. So in the judgment, in respect rather of both the income tax and VAT matters, SARS was granted leave to amend its statement of grounds of assessment, its Rule 31 statement, but SARS did have to pay the costs of the application for leave to amend, the application to strike was dismissed, and SARS was also ordered to pay the costs of that application or those applications. The tax appeals, both of which had been set down, were postponed in ADA, so indefinitely, and SARS also had to pay the wasted costs occasioned by this postponement, or those postponements rather. The gist of it, or the relevance of it, is as far as the tax court's discretion to grant an amendment of a Rule 31 statement by SARS, is that as a general rule, the court will, as it is in the High Court, as it has always been, will as a general rule grant this amendment unless it can be shown by the taxpayer that this application for the amendment was brought in bad faith, it was mala fide, or if granting the application would cause some prejudice or some, injustice to the taxpayer, which couldn't be remedied by a cost order.
Right, thanks, Liesl. So ultimately, SARS was allowed to amend its Rule 31, but it had to pick up the cost of all this delay and of the application itself to actually amend the thing. Right, which makes sense. I think it's strange that the thing was allowed by the taxpayer's representative to drag on that long. I would long since file an intention to apply for default judgment, long since have been done and dusted, but anyways. Right. Then we're dealing with this default judgment that this taxpayer had the audacity to bring in the tax court. And I say that because it is absolutely shocking. I found it extremely fascinating reading this judgment that someone could be or seem to be so brave, if you could use, or let's use ignorant rather, ignorant as to the rules. But anyways, let's explain what happened here. All right. So this taxpayer ultimately, or this issue in front of the court in CM versus SARS, was whether or not the court should grant default judgment in favor of the taxpayer. And if SARS were to grant default judgment in favor of the taxpayer would have been in a position where SARS had to reduce an assessment from 44 million rand to zero. Right. So you can see that's quite a substantial number. And if the court grants it, it would have saved the taxpayer 1 or 2 rand. SARS naturally opposed the application for default judgment. Right. So what had happened here is in the taxpayer's tax return for the 2014 year of assessment, it reflected that she had taxable income of 365,000 odd and also received a donation from a foreigner which was not subject to tax. Right. Now, SARS obtained certain preservation orders and ultimately started asking eventually questions about this donation, because you will see in a minute it is rather a substantial donation that it received. And eventually SARS and the taxpayer reached a settlement to say, okay, you've received 142 million, that's a typo in the slides. So the taxpayer received 142 million rand, which it declared, at least it declared it, that's nice. It declared 142.9 million rand as a foreign donation. And what we'll do is we will, SARS, we agreed, we settled, signed a settlement agreement, we will tax 110 million of that. The balance we agree is a pure gratuitous donation, but for 110 million, that's taxable, right? So SARS also agreed in the settlement that they would not raise interest or penalties on the late payment of the tax, and funds that the taxpayer's foreign benefactor would pay to her will also be recognized as a foreign donation. Because what happened here is, as soon as the foreign benefactor, that's a nice word for it, as soon as the foreign benefactor realized that there was going to be a tax bill on this, the foreign benefactor said, I'll pay the tax bill as well, right? So I'm donating 142 million, and I'll donate to you the tax on the 110 million as well. I also want to have someone who donates to me 142 million rand just because they're nice. Maybe I'm not pretty enough, right? Because I think that might have got something to do with it, right? The settlement agreement was then approved by SARS, so they actually formally entered into the settlement agreement. Now, when you look at the rules in the Tax Administration Act, it says if an assessment is issued following a settlement agreement, the thing is final. You cannot object to it. It is final, it's done. I think it's section 100 or section 99 of the TAA that says it's final. Or 95. Anyway, be that as it may, it is tried law that the settlement agreement is final, right? So in consequence of the settlement agreement, SARS then issued an additional assessment on 17 February 2016. That was now, so there was this issue, this was a fight, there was a settlement agreement, and they issued an assessment to give effect to that. And then, interestingly, during September 2018, the taxpayer or the applicant objected to this additional assessment, right? So first of all, the thing is out of time. And second of all, you cannot object to it, but that's what happened, right? So it's out of time, way out of time, and you can't actually object to it, but that's what they did. They're essentially exploiting the e-filing system. That's what happened here. You can see it as we go through the rest of this. Right, so during September 2018, they objected, and although the slides here says SARS nevertheless allowed the objection, what it's supposed to say is that SARS condoned the late objection. So when you file an objection and it's late, you get the notice to say, yes, okay, we've condoned the late thing and we will now consider your objection. And that's what they got, right? Right, they are condoning the lateness of the objection. And then SARS, having realized that this is a bit of a mistake, they wrote in December 2018, a couple of months later, to the taxpayer to inform her that the decision to allow her objection or to condone her late objection or to condone the lateness of her objection was under review. Right. Now, eventually SARS withdrew its decision to condone the late objection, which indeed they can do in terms of Section 9 of the TAA, because Section 9 says if SARS has made a decision other than a decision given effect to an assessment, and a decision you can't object to, then you can ask SARS to review the decision. But SARS can also on its own review its own decision. It's clear as day in the provisions of Section 9. Because I'm saying that because the taxpayer sometimes tried to fight whether or not it could withdraw its decision to condone the late objection. But anyways, they condoned it. Now, the taxpayer argued she never received this letter that SARS withdrew their decision and wasn't aware of the fact that SARS was reviewing their decision to condone, and then launched a default judgment application against SARS, again exploiting and abusing the court procedures. But they filed a Rule 56 because in the taxpayer's mind, I filed an objection, you condoned the thing, I didn't get your notice of saying you've changed your mind, and so you are supposed to make a decision on my objection, and you haven't, so I'm applying for default judgment. Right. It's interesting, I can't even, because this taxpayer, in this case, in all matters up until here, was represented by her father, if I remember that correctly.
It was an attorney.
It was initially an attorney. Okay, but in the default judgment application, it was the father. Okay. All right. So ultimately, SARS withdrew its decision, what had happened is when SARS withdrew its decision to condone the late objection, on e-filing, the system generated a notice of invalid objection. Because we all know those notices. You file the thing, if they don't want to condone it, they issue you with a notice of invalid objection to say it's without time. Right? And then it clearly says if you want to file another objection, you must do so within 20 days. And also, in terms of Rule 52, you can apply to the tax court if you don't want if you want to have the objection declared valid. But the taxpayer didn't do that. The taxpayer said fine, or the taxpayer's father or whatever, didn't do that. It said, I've got this notice of invalid objection. I'm now going to proceed on appeal. Again, absolutely incorrect, right? But that's the process that was followed. SARS responded to this appeal launched by the taxpayer, because this was also filed via e-filing, I would imagine, right? Which is odd, because I understand the e-filing system stops you from doing that unless there's a decision to disallow. No, okay. So SARS responded, stating that the taxpayer's appeal had to be preceded by a valid objection, and that the taxpayer could also seek alternative relief if she disagreed with SARS's decision to declare the objection invalid. Effectively, what they said is you must go to the tax court in terms of Rule 52 to ask for an order to declare the objection valid, but as it stands, you have an invalid objection, so you can't appeal. Right. On 15 May, the taxpayer delivered a notice to SARS demanding that SARS remedy its failure to respond to its notice of appeal. Right, so SARS, having made its position clear, ignored the taxpayer, and so I would have also. The taxpayer proceeded then to apply for default judgment. Right, because now the taxpayer said, I filed an appeal, you must answer me, you're not answering me, so I'll apply for default judgment. Right, the arguments for the taxpayer was that the SARS's notice of invalid objection was really a notice of disallowance because it ruled on the substance of the matter. Now, I don't know how many of you have seen the notices of invalid objection that's typically issued. There is no way in any stretch of the imagination that you could possibly conclude that they ruled on the substance of the matter. Sometimes they could say something which is completely wrong, but that's a completely different discussion, where they would say, I'm declaring the objection invalid because you didn't give me proof of your travel claim, which is nonsense. That's fine. Then they've made a decision on the substance. But typically, if the objection is late, they'll say it's invalid because it's not within time and you haven't proven the existence of exceptional circumstances. Right. So, but that's what the taxpayer said. And also that based on the interpretation of the relevant provisions, SARS had not been at liberty to withdraw the condonation granted initially. And that's the point that the taxpayer was raising, that SARS cannot, in terms of Section 9, review the decision to grant condonation, which they indeed can. And the court deals with that swiftly and says, of course they can. All right. The arguments for SARS was simply that it's based on procedural grounds. Before you can file an appeal, you must have a valid objection which has been disallowed, right? And on the basis that we've declared your objection invalid, you could not file a notice of appeal. It's as simple as that, right? The taxpayer could have brought an application in terms of Rule 52(2)(b) to have the objection declared valid, but they didn't do that. They went on appeal, and that's outside of the procedure. Right, or to the High Court to have it reviewed in terms of parja. I don't think, though, you could actually go to the High Court, because you'd first have to exhaust 52(2)(b) in terms of 7.2 of parja. You'd have to do that first. But anyway, and ultimately the court said that the application for default judgment was dismissed, and this for me is fantastic. The taxpayer was ordered to pay SARS's costs, including the cost of two counsel, on an attorney and client scale, which is the highest scale you could get. It's effectively not the highest, but second highest, and it's effectively a punitive cost order. The taxpayer abused the process and exploited SARS's systems. Now, it's unfortunate. When you read this judgment, you actually, there's a point where the court says it's extremely surprising that it was astonishing or something. I don't remember the exact words. Astonishing that the thing was declared valid in the first place. Now, that's probably a system-generated thing. I don't know. I couldn't really care. But it's astonishing that it was allowed. But if there's anything you take from this judgment, apart from the fact that it's fascinating and funny, is that SARS can indeed change their mind. If they've granted a condonation request to condone a late objection, they can change their mind in terms of Section 9. I think they can't do it at any point in time. They can't, after you've got an appeal, now declare your objection invalid, although Section 9 doesn't set a time period. So, but I don't think their powers are completely without limit, but they can change their minds, right? And rightly so. All right, let's move on. See, we've been going for an hour and you thought it's going to be quick. See, if I start talking, it's never quick. All right. Right, and the appeal and subsequent default judgment cannot be resorted to by the taxpayer if you haven't followed a valid objection. We all get that. Right. Right. A very interesting judgment. This, I think, is this the last judgment? Right, so this is the last judgment. I'm not going to break, so we'll push ahead and then we'll take questions at the end. All right, so the issue in front of the court in this case, which came out last week, Friday, was it? 15th. Wasn't that other one on the was also on the 15th, right? All right. So we all know that if we make taxable and exempt supplies for VAT purposes, you must apportion your input tax claim. And the standard method for doing so in terms of binding general ruling 16 is the standard turnover-based apportionment method, unless you apply to SARS for a ruling to say, I want to use a different method. Right, now this is what happened here is the taxpayer applied to SARS. Let's just get into the facts. Right, the taxpayer applied to SARS for a ruling, and they wanted a particular type of method. I recall it as a transactions processed method, but they call it something else. Transaction count based method is what they call it, or whatever the case. So it's just a different method to make the apportionment more fair and reasonable. And when it comes to VAT apportionment, we could talk about it for ages and whether it's right and whether the turnover-based method is fair and reasonable. In most cases, it's not. It doesn't make any sense, right? But that's the standard method. So the taxpayer eventually applied. I'm not going to give you that history. You all know that. So yeah, the taxpayer applied for a transaction count-based method, or I call it transactions process method, of apportioning its mixed purposes input tax deductions. And it wanted SARS to rule that it could use that method from the 1st of February 2014 until at least the 29th of February 2016. Well, they wanted it backdated from the 1st of February. I don't think it was actually to the 29th, but it was at least from the 1st of February 2014. That's what they wanted. So they applied for it and SARS granted the ruling. Right. But the problem is that the taxpayer wanted it backdated from a certain date. Well, now the taxpayer applied for this ruling on the 20th of February 2017. And when you look at section 17, it actually says that you can apply for an alternative method, or you can apply to SARS for a method, but SARS cannot backdate it to a period falling in a time outside the year of assessment in which you applied. So if you applied on it on the 20th of February 2017 and your year of assessment ends on the 28th of February 2017, then the latest I can backdate it to in terms of section 17 is the 1st of March 2016, because that's a period falling in the year of assessment that you applied. And the taxpayer wasn't really happy with that. Right. So the taxpayer objected to SARS's refusal to backdate the ruling. Now, when you look at section 32(1)(a)(4) of the VAT Act, it says that if SARS refuses to grant an apportionment method, you can object to that. Right. Now, what it doesn't say is that you can object to SARS's refusal to backdate the ruling. Right. So what had happened is SARS on that basis said, I'm going to declare your objection invalid, right? Because you can't actually object to it. You can object if I refuse to grant you a ruling, which I didn't do. I granted you the ruling that you asked for. I just didn't grant it retrospectively. And that's not subject to objection and appeal, and therefore declared it invalid, as far as we can tell from the judgment. The taxpayer then wasn't happy with that, and then eventually took the matter on review in the tax court to ask the tax court to have the thing declared valid, which the tax court eventually ordered that the objection must be declared valid. And so now the objection is valid. SARS must consider it. They consider the objection and disallow it. Right. Effectively, that's what it comes down to. And the taxpayer then took it on appeal, and that's where we are at now. So what did the taxpayer argue in the tax court for retrospectivity? Now, I can take you through this, but it's rather interesting. And what it all comes down to, the argument, as far as I can tell, was that when you look at binding general ruling 16, it says that if the standard turnover apportionment basis doesn't give you a fair and reasonable result, then you must use or apply for a different ruling. So it doesn't say it's always the default. It says it can only be the default if it's fair and reasonable. That was kind of where they were heading with their argument, to say it doesn't say the default. It says it's only the default if it's fair and reasonable. So if I conclude that it's not fair and reasonable, then I can apply for something else. And if I can't backdate it, then effectively binding general ruling 16 is redundant, because at what point in time do you then start applying something else? But if you're struggling and you're frowning, struggling to understand what they were arguing, don't worry, I also didn't understand it, and neither did the court. And eventually said, no, it's nonsense. The legislation is clear. You cannot backdate the thing. All right. The taxpayer also wanted costs from SARS for this application that it had to bring in the tax court for having the objection declared valid, as far as we can tell from the judgment. Right. So, and if I recall the judgment correctly, the court actually granted that because SARS shouldn't ever have declared the objection invalid. It's interesting when you think about that, because that in and of itself is an interesting point, is whether or not the taxpayer can object to the retrospectivity of the ruling, because SARS here raised it again in this court as a defense, right? To say, well, the tax court doesn't have jurisdiction to hear it because it's not subject to objection and appeal. And the court ultimately says that if you look at the section that says you can object and appeal to SARS's refusal to grant a ruling application, if SARS doesn't retrospectively allow it, then they've effectively refused to give you an apportionment method in respect of those periods. So it would be wrong, the court says, to interpret the provisions of the VAT Act so strictly that you can only object to a decision and not to the retrospectivity of the ruling. So a court and then the taxpayer said, well, I want costs for having to bring that application. SARS responded, first of all, raising, as I've just said, the tax court lacked jurisdiction because the taxpayer can't object to this. Court dealt with it as I've explained and said, of course I can. And then SARS said it argued that it had not refused to approve the method, but there's all jurisdiction, and ultimately came to the view that Section 17.1 places an obligation. That was the argument. Section 17.1 of the VAT Act places an obligation upon a vendor who must apply to SARS for an alternative ruling if it is of the view that the standard-based method is not fair and reasonable. In fact, it says in so many words, if I recall correctly, in Binding General Ruling 16, if it's not fair and reasonable, you must apply for another ruling. So the taxpayer's entire argument really fell flat just on that basis alone, because the court accepted the argument from SARS to say, well, you must apply, and what happened here is you simply didn't apply in time. That's what it is. You should have applied sooner, right? And you can't just simply, and I've seen this happen before, guys use different apportionment methods. They do their input tax. They know they're supposed to apportion it. They don't like the standard apportionment method, and somewhere someone told them that if it's not fair, you can use something else. Probably along similar arguments that was raised by the taxpayer here. I don't know how they get to that, but that's what they said. And in this judgment, the court said, no, you can't. You have to. If you must apply for a different ruling, and you must apply on time, right? If you have a problem with it only going back to a certain point, then you should have applied sooner, right? And because they got the ruling. They got the ruling to say you can apply it, just not as far back as they wanted it. And naturally, that could have quite severe consequences, right? Right, that was the judgment in a taxpayer versus SARS. I found it interesting. And then just briefly, roughly the ratios, the win-lose ratios, they haven't been updated for last week, Friday's judgments. So apologies for that, but it wouldn't make a significant difference. But it really hasn't changed from the previous session. You can go through that in your own time. Right, just the win-lose ratios in the tax court, high court, SCA, and constitutional court. Right. Oh, there's the list of things that we haven't covered. We haven't covered income tax case 4412, which deals with medical expenditure because, well, it's so trite. I honestly don't think it's necessary. But if there's interest, we'll cover it next year. ITC 14255, which deals with an organ of state. Really very specific. I don't know how many of you operate and advise organs of state, so that's why I've put it on the not covered list. Binding Private Ruling 331 deals with the degrouping charge. There's that rule in Section 45. You do a 45 and you degroup, there's certain tax consequences that follow. I thought, again, it's a little bit too specific and decided not to cover it. And then Binding Private Ruling 332, unbundling and subsequent issue of listed shares by a non-resident subsidiary of a resident holding company. Very, very specific. I've decided not to cover it. But again, if there's sufficient interest, I do intend to do this again next year as I'm sitting here. So we are more than willing to entertain that for next year's session. Right. Let's see what's next. Rollovers. Nothing. I'm not rolling anything over to December because in December I'm not doing a tax update. We'll do one again next year, probably late January. Right. Any questions? Please, I don't know what this means. Please use the question portal on iLearn to post any questions. I would imagine it's the system, so I imagine you know where to post questions. Right. Wendell, where do I, the Q&A mode. So there we go. I remember now. Okay. All right. Let's look at some of the questions. Okay, so what? So, sorry, I can't see very well. Shanae Botha or Shanray Botha, Shanray says, what if there was income as defined? Would the catch-up then be allowed? No. No. That I think what happened, are you referring to the judgment on 13 Quin? I don't think so. I think they just misinterpreted, everybody there misinterpreted what section 13 Quin 3 was supposed to achieve. You cannot catch up a 13 Quin allowance that you haven't claimed in previous years. You have to go and claim it in that year. So there's nothing, I don't think there's anything that stops this particular, apart from prescription, that stops this taxpayer from going back and fixing it. And even despite prescription, maybe you could try, it's a processing error, but that's unlikely to fly. So 93(1)(e). So you could go back and object, and if the objection route isn't available, you can try 93(1)(d). You could try 93(1)(e), although I doubt that'll be successful. So you have to go back and fix it in that year. It's frustrating, I know, but then you shouldn't have made the mistake by not claiming it in the first place. Right. Surely, if that's the purpose of the section, then it should only apply if the reason for the non-claim was the taxpayer was exempt previously. Carl, let's see if I get that. Surely, if that's the purpose of the section, I'm not sure if you're referring to the purpose according to the tax court or the actual purpose. Because, Carl, surely if that's the purpose of the section, then it should only apply if the reason for the non-claim was the taxpayer was exempt previously. No, I think really, guys, it seems that it's easy to misinterpret section 13 Quin 3. It simply says, if you were exempt previously, not in so many words, but that's kind of the gist of it. If you were exempt previously and you owned the building and you could have claimed, but you were not trading, or you were exempt, so therefore you couldn't claim any deductions, then you are deemed to have claimed it. Otherwise, you would have been able to make the argument to say, I'm only taxable now for the first time, and so I'll start claiming now. And that's what they said in the explanatory memorandum when they introduced the section. That's what they were trying to stop. If you missed it, you missed it. It's one of those things. Go back and try and claim it there. We recently had a case where a taxpayer, it was actually only an accounting error that resulted in their profit being overstated by 60 million, and they paid the tax on it, and we had to go back and fix it. So they tried previously to claim it in other years and all sorts of interesting things, bad debts and everything. They tried, all of it failed. And I said, no, you have to go back and claim it there. And we were eventually successful. It was quite a mission, but you have to go back and fix it in that year. Right. Vanya, or if the accountant forgot, could they not just go back and, yes, that's what I just discussed. They can, subject to prescription. But that's pretty much it. There's only prescription and objection, exceptional circumstances, and those things. Advance, I don't think that's a question. Right. Query in respect to section 13 Quin. If the taxpayer had taxable income and not exempt income as per the case, would the same approach be followed in respect to subsection 3? And will SARS still disallow? Yes. Right. Please cover income tax 14255. I do deal with organs of state. Chaya, if there's sufficient interest, we'll certainly cover it, but I can't cover it if there's only one person interested in it. If you're interested, I can send you the judgment, but unless there's sufficient interest in it, unfortunately, I cannot cover it. Is the final court judgment in all cases the solution or answer to all queries? Is the final court judgment in all cases the solution or answer? Joey, I'm not sure I understand what you mean, but you don't necessarily have to go always to tax court. It just unfortunately happens from time to time that that's the only place where you can actually get some form of solution or some form of finality. But sometimes you get this, I almost used the wrong word. Sometimes you get the stuff, let's use the word stuff. Sometimes you get the stuff sorted out before you have to resort to litigation. And ideally, that's where we all want to be, because it's time consuming and not overly expensive, but more expensive for most cases than what it should be, because you shouldn't have to do that old tax court thing. But sometimes it's unfortunately the only real option to get things done. Right. this is nothing to do with today's webinar. Right, let's see if I can wing it. Do you have any experience with cooperatives? I have a client that wants to start one. Can you assist? Greta, I have no idea. Unfortunately, Vickers, cooperatives, Liesel, cooperatives? No. Sorry, Greta, unfortunately not. Then Carl has got a follow-up on his 13 Quin question. It seems to only apply where the reason for the non-claim was exemption. So the deeming would not apply just because you forgot. So sure, you can't go back, but surely you can go forward without having been deemed to have claimed. Right, Carl, you could try and have this debate, but ultimately, as the court also says, is that the tax event is an annual event, and you have to claim it in that year. There are many provisions that says in that year, you have to claim it in that year. You can't catch up. And I understand all the arguments that you could raise to say why it doesn't make any sense. That's so. And tax legislation is not fair. In fact, the SCA not too long ago told us it's not fair. So what? That's what the law says. So we have to unfortunately deal with it. Happy to debate it, Carl, if you're interested. Has the not responded cases added to your website already? I could not find it this morning. Not reported cases added. Chaya, are you referring? Oh, you're talking about the not covered cases. They don't typically get onto the website. But I can email them to you. Just drop me a mail and then I will forward you a copy of the judgment. Right. If there's anybody else interested in it, you're more than welcome to send me an email. Right. Carl is saying, so then the section has no point. Carl, the section does have a point. If you claim it in that year, you get the benefit. If you don't, you have to go back and claim it in that year. So the point of the section is you get a tax deduction for the cost of the building if you claim it in the right period. That's the point of the section. But unfortunately, you have to do it in the right year. It's tried law. I mean, I don't think it's really that big of a deal. All righty. Guys, are those all the questions? It seems that way. I'm going to give it 1 or 2 minutes. Wendell from side. I don't know if there are more questions that I'm missing. Maybe I'm not understanding this system. But I think that's where we get the questions. Right. Right. Right, guys, wait, hang on. Right. No, sure. Let's agree to disagree. All right. Let's see. I've got the message here from site. Is there more questions? Hi. Maybe I shouldn't read it. Okay. So I've covered all the questions. Thanks. All right. Thank you, everybody, for listening. It was great chatting to all of you throughout the course of the year. And thank you for Liesel, Vickers, and Elsa Marina absence for helping me prepare for these things. It would have been an impossible task without your assistance. So thank you for that. Thank you for everybody who listened. And then if you'll have us, we will gladly do this again next year. All right. Thank you for listening. All the best. Keep well. Bye-bye.